Good afternoon and welcome to the Prince George's Community Federal Credit Union 2017 Lunch and Learn series. Today's presentation is brought to you in partnership with Coffee, a nationwide financial coaching and education center focusing on improving the financial health of individuals. As the premier credit union of Prince George's County, they have joined with Coffee to expand their mission of providing quality financial education to their community and leading insight into credit management, home ownership, and money management. Prince George's Community Federal Credit Union is a full-service financial institution serving anyone who lives, works, or worships in Prince George's County, Maryland. This year they are celebrating 50 years in business and are one of the county's best-kept secrets with competitive loan and savings rates as well as discounts to national retailers. They currently serve over 16,000 members in the area and welcome you to come and experience the benefits of membership as well. Later on in the presentation, I will display their contact information and answer any specific questions you may have concerning your financial needs. Please note that today's webinar is live and all phone lines have been muted. If you have questions, please feel free to type it into the question field on the right-hand side of your menu bar. All questions are private and will be addressed at the end of our discussion. We will be offering a free 60-minute financial coaching session with the completion of 3 webinars. More information will be given at the end of today's presentation. Lastly, a recording of today's session will be available within 2 days. Details will be sent to your email following the presentation. And with that being said, I would like to introduce myself. My name is Charmaine Williams, and I will be your presenter today. We're going to go ahead and get started, and today's presentation is all about mortgages. A mortgage is made up of at least 2 legal documents: a promissory note indicating a specific amount that will be loaned at a specific interest rate, and a security instrument which pledges the property to the lender if the note is not repaid. Each month you will make a payment consisting of principal and interest. The monthly payment often includes an escrow amount for taxes, insurance, and association dues if applicable. The principal is a portion of the amount borrowed. The interest is the fee charged by the lender for the amount borrowed. Taxes would include property taxes. Insurance would be homeowners, private insurance, flood insurance, etc. And any owner's association dues, excluding any utilities charges that apply to the individual unit. The more down payment you put down, the less your monthly mortgage payment will be. A loan with a down payment less than 20% may require private mortgage insurance, or PMI, which is required to be paid until the loan amount compared to the value of the home achieves 80%. Your home serves as collateral for the loan until the mortgage is paid off. And interest rates, along with the term and the amount of the loan, determines the size of the monthly principal and interest payment. There are 2 different types of loans: conventional and government issued. Conventional loans are not insured or guaranteed by the federal government. The 2 largest conventional mortgage providers are Fannie Mae and Freddie Mac, and they usually require mortgage insurance if your loan to value is greater than 80%. Now, government-insured loans are insured or guaranteed by the federal government. The 3 largest providers are Federal Housing Administration, or FHA, the Veterans Affairs Administration, the VA, and the Farmers Home Administration, the FMHA. And those always require mortgage insurance, regardless of the loan amount. So government loans. FHA mortgages are usually ideal for first-time homebuyers, requires a low down payment, and can come from a variety of sources, example, gifts, grants, and various assistance programs. They're more flexible underwriting guidelines than conventional loans. They have fixed and adjustable rates and no income limits. For VA mortgages, you must be a veteran or on active military service to qualify. No down payment required up to $417,000 with full entitlement. More flexible underwriting guidelines than conventional loans. They also have fixed or adjustable rates and no income limits as well. So when it comes to choosing a mortgage, you have certain options. You can get a fixed or adjustable rate mortgage. A fixed rate mortgage is the interest rate is fixed during the whole term. You have consistent principal and interest payments throughout the life of the loan. Common terms are 15 and 30 years, but 10, 20, and 40 years are also available. And it's a good option if you plan on staying in your new home for a long time and prefer the certainty of monthly payments. Now, an adjustable rate mortgage, or an ARM, they typically have a fixed interest rate for the initial agreed upon period, which then adjusts annually for the remainder of the loan. Interest rate caps are set to the maximum amount your rate can increase or decrease at each adjustment or for the life of the loan. A good option if you plan to stay in your home for a few years or expect your income to increase substantially. Now, other things to look at for your mortgage options are points. A point is an amount equal to 1% of the principal amount of the mortgage. Loan discount points are a one-time charge assessed at closing by the lender in return for a lower interest rate. This is a great way to reduce interest costs over the life of the loan. And next is your annual percentage rate, or your APR. That's the annual cost of the mortgage expressed as a percentage and includes the interest rate, points, and closing costs for your financing, along with the original loan amount. The lower the APR, the lower the mortgage costs. Now, also things to look into are rate locks and floating. Your rate lock, the rate is set for a number of days during which the lender guarantees a borrower a specific interest rate and mortgage terms. Various rate lock options are available, so you want to speak to your mortgage consultant to determine which option is suitable for you. And lastly is the floating. The rate fluctuates until the loan is locked or before the loan is ready to close. So these are all great questions and information to find out from your mortgage professional. How much mortgage can you afford? The most general rule of thumb is that you can afford a home of about 2 to 3 times your annual income. Lenders look at two types of ratios to determine how much you can afford. Your housing or front-end ratio, which includes monthly housing costs, which are mortgage payments, property taxes, insurance, and monthly maintenance fees, if applicable, as a percentage of your monthly gross income. Your total or back-end ratio, that includes monthly housing costs, plus monthly payments on consumer credit and other long-term debt as a percentage of monthly gross income. The general guidelines are your front-end ratio should not be more than 28% of your monthly gross income, and the back-end ratio should not exceed 36% of your monthly gross income. So when you go to your bank or your credit union to apply for your mortgage, they're going to ask you for a lot of paperwork. So it makes sense to start collecting all of this documentation now, so that way you're well prepared for when you get to your lender. They're going to ask you for employment and income verification. They want the most recent pay stubs, 30 days worth, the last 2 years of W-2 forms for all employment for both borrowers or individuals, last 2 years signed tax returns, including all schedules, rental agreement for any investment properties that you may have. Next, they're going to look at your assets. Most institutions want the last 2 months of bank statements, brokerage statements, retirement, 401k, IRAs, etc. Some may ask you for 3, 4, or more, so be prepared. Property information for any other properties you may have, lien holders, account number, monthly payments, current balance, and market values, etc. So any assets that you may have, they want all the documentation on that. Then they're going to want to know about your debts. List of current lenders, monthly payments, and the amounts that you owe. Bankruptcy discharge papers if you filed bankruptcy in the last 7 years. Copies of 1-year cancel rent payment checks if you've been renting. Next is identification. Government or state issued documentation with photographs which contain either an identification number or date of birth, such as a driver's license, non-driver photo ID, passport, or etc. So you want to get all of this information gathered together before you go in to see a lender for a mortgage. When you get there, the next thing they're going to do is pull your credit report. So another good thing to do is have a copy of that or pull it before you know you're going to go to apply for a mortgage. This way, if you see anything that's mistaken, if there is anything wrong, you can start to correct those errors early. So mortgage lenders review the credit report to evaluate the borrower's credit behavior. The credit report shows the types of credit that you have, whether it's installment loans, which could be an auto loan, student loan, credit cards, or an existing mortgage. Your credit amount and utilization, the balances that you owe, the timeliness of your payments, the number of new inquiries, whether you've been applying for credit or not, past credit problems, which would include judgments, bankruptcies, foreclosures, any delinquencies, or collection accounts. So before you go and have them pull your credit for you, you want to know what's on your credit report, and you want to correct any errors before submitting your mortgage application. Now, applicants without any credit history will be asked to provide alternative documentation such as proof of timely utility and rent payments. If you were to Google what is known as alternative credit, there are a lot of different sites out there that you could sign up for, and any bills that you pay on a monthly basis can be added to what is known as an alternative credit report. So that's something good to look into. Now, if you have damaged credit, if damaged credit is keeping you from getting a loan, then you want to take some steps to get that taken care of, You're going to want to give yourself enough time to repair the damage and rebuild your credit. You may want to work with a HUD-certified housing counselor so that they can help guide you in the right direction and also help you develop an action plan of what steps to take. You also want to pay down your debt on time because 35% of what makes up your credit score is payment history, and 30% is the balances that you owe. So pay on time and get those balances lowered to help bring your score up. If you know you're having difficulties, you may also want to talk to your creditors and work out payment arrangements, and maybe they will be able to re-age your account. So that's something to look into. Now we're going to go through the mortgage process. First things first, borrowers will submit an application to the lender. The lender provides the borrower with a loan estimate, which itemizes the fees and costs for the loan and a closing disclosure within 3 business days. The borrower considers the loan and may even compare against other loans. Lenders will wait for the borrower's consent to proceed before they take any further steps with the loan, such as charging the application and or commitment fees, ordering an appraisal, or requesting any documentation from the borrower. The property will be appraised, and the title report is ordered to search for any liens on public record. The lender reviews all the documents and makes a decision. The borrower will then be informed of the decision and any additional conditions to be approved. The lender clears the file and coordinates for escrow accounts, verification, etc. Then you get ready for closing and or settlement. While you are applying for a loan, you don't want to sabotage your chances against getting that house. You've gotten approved, and now it's almost time to close. Do not sabotage your loan. You want to return your realtor and loan officer's calls as quickly as possible and provide them with any documents or information that they need right away. Please do not lie on your application, because if and when they find out, that can cause your loan to be turned down. Also, you do not want to incur any new debts. You don't want to buy that new car for the driveway or new furniture for the house before you're closing, because your lender will pull your credit before then, and if you have added new debts to what you already had, that will change your debt-to-income ratio and cause them to turn you down. Do not quit or change employment before your loan closes. The only way you can switch employment is if you're staying within the same profession. So, for example, don't go from being a teacher to being a chef while you're in the closing process. You want to stay within the same profession. So if you are being offered more money at a different school to still teach, that's something that you'd be able to do. But you don't want to switch professions in the middle of your mortgage process. Okay, so you don't want to sabotage your loan. You want to make sure that everything you're doing is what's supposed to be done, and definitely, most definitely, cannot stress this enough, do not incur any new debt. Yes, you may want to furnish your new home with all of that stuff from the great furniture store down the street, but wait until you signed your closing documents and you have your keys, then you can go and finance your new furniture. So this was a quick and short presentation. If you have any questions, please feel free to type them into your question box now. we have a representative from the credit union on the line just in case we need to answer any questions. But again, she's going to say that you would have to call the credit union at the numbers I'm going to give you at the end because she is not a mortgage representative. So due to certain laws and restrictions, you would have to call the credit union yourself. So if there are any questions, please feel free to type them into the box, and then if I can answer them, I will. If there's something for a specific mortgage professional, I'll give you the numbers, and you can call the credit union at your convenience, and they'll be happy to help you. Oh, there's a question. All right, so I don't see any questions. We're going to go ahead and continue. I would like to thank you for attending today's educational webinar. To learn more about Prince George's Community Federal Credit Union or to speak to a member service representative, please visit www.princegeorgescfcu.org or call 800-952-7428 or 301-627-2666. Hold on one second. There's a question. Once you clean your credit, how long do you have to wait? All right, so the question is, once you clean your credit report, how long do you have to wait to apply for your mortgage? Most case scenarios, lenders would like you to have at least 12 months on-time payment history. So if you know that you've been paying or you've re-aged your account and your credit score is where it's supposed to be, then you could go ahead and go to the bank and apply for a mortgage. If there's anything that they want you to change that they'll see on your credit report, they will definitely let you know. But if you know to yourself that you've done everything that you're supposed to do and you've gotten what needs to be off, any mistakes off of there, then you could go ahead and apply for your mortgage. You don't have to wait a specific amount of time between fixing up your credit report and then going to apply for a mortgage. So I hope that answers your question. To schedule your free 60-minute financial coaching session, please call Coffee at 866-459-5165. Oh, another question. How does the refinance process work? That would be a great question for you to contact Prince George's Community Federal Credit Union with. A mortgage expert will answer that question for you properly so they could explain it step by step, how it works, and what it is you would need to do to start that, and what the process would be. Okay? Are there any other questions? Or is everybody okay? All right. Well, what is re-aging a loan? It's not re-aging a loan. It would be re-aging your accounts. That's if you were to be in default, I should say, like say you have a credit card and you haven't made payments for 3 months for whatever reason, and you would like to go and apply for a loan. You want to call that credit card company, explain the situation, start making payments, and have them possibly re-age it for you. So which they would take off the negative information off of your report, and it would start your account from the date that you started making payments. Okay? I also want to let you know about a survey after the webinar and the free, you're very welcome, the free coaching that would be available. Again, to schedule your free 60-minute financial coaching session, you'd want to give Coffee a call at 866-459-5165. Are there any other questions for me? I hope I've answered everyone's questions. I hope you guys are in full understanding. Again, you want to know more about the mortgage process, definitely give the credit union a call, and someone there will be able to answer all of those questions for you and help you out with everything that you need. Thank you all again for attending. Thank you for taking time out of your day. We're all finished.